Silicon Valley and Signature Bank's collapses triggered fearful flashbacks to 2008, but our next guest says the problems plaguing SVB and Signature are unique, and when paired with the government's swift response, better days could be fast approaching. Joining me now is Seth Berenzweig, managing partner at Berenzweig Leonard. Good to have you back on the show, Seth. So we saw this panic when there was this fear about this contagion or whether or not it was systemic. You say that this is overblown. Walk us through that.
Well, I think that while there are certainly risks in the system, there's a lot of things that are being overblown, and there is a misperception of what the real risks are. So just to clear the table a bit, there have been fundamental misconceptions about how the FDIC and its insurance program works. I had the pleasure of actually working at the FDIC for several years. In a prior chapter of my professional career, I can tell you they're tremendous people that can move mountains pretty quickly, and they're actually going to be selling off these bulk of deposits within the next couple of days, which is pretty incredible. But when we hear about references to bailouts or national takeovers, that's not what's happening at all. We have not only a privately funded insurance program, but we have a very elegant system in place now that was created in a very novel way over the weekend, where we now have this lending facility that's also backstopped by the United States Treasury. That has really instilled confidence in the markets here in the United States. And I do believe that it is fundamentally protective and safe to say that people's deposits are secure. Now, of course, we had another black swan event fall out of the sky with Credit Suisse, although now they have a lending facility too. I don't believe that there are the risks that are on the table that are being discussed. There may be a few canaries left in the coal mine, in that there are still portfolios of larger banks that still have these long-term treasury bills that are yielding in the low figures. The difference in the uniqueness of the crisis in California over the last couple of days is that their portfolio of those instruments is at about 50%. The typical bank in the United States have these short-term and long-term treasuries that are closer to about 15%. So the bottom line is that I believe that we are safe right now, although it sure would be nice to stop seeing these black swans fall out of the sky.
It certainly didn't help with Credit Suisse coming right after that, although Credit Suisse has its own set of problems that was already leading up to this. You mentioned that a few other banks could be in a similar position. Are there any in particular that stand out to you?
Well, First Republic certainly seems to be under a lot of pressure, and it's very difficult to say. JP Morgan has certainly swooped in and they've come to the rescue. So in addition to the new lending window provided by the Fed, JP Morgan has come in to help them. I think the biggest problem in terms of what's happening right now is that we've learned on a week-to-week, if not even at a day-to-day basis, that we just don't know what we don't know. But the good news is that we really do have a very agile and creative joint task force. What's happening right now is we're living in a historic moment in terms of the regulatory environment that is surrounding the banks. We really have a full court press because we have the FDIC, we have the Treasury, we have the Fed that are really creating a joint task force to go in and really back up these deposits. So in the short term, we have the lending window, which decreases the risk. And if there has to be a sale of these bonds, they can be done in a non-distressed manner. They can be submitted as collateral security at par, which means that the pressure is taken off. They don't have to run a fire sale, and then we're not going to have all of these liquidity runs. At the end of the day, what we really have right now is more of a crisis of confidence. The biggest risk that I see out there right now is that the ECB just raised rates. We're going to have to see what Jay Powell tells us next week. And the more that you have an interest rate spread, that's going to affect these other instruments that the traditional banks are still holding roughly 15% of their portfolio. We're not out of the woods yet, but the American depositor, I believe, on balance, should be relatively secure that their money in the American banking system is safe.
So, Seth, while we do still have this, as you mentioned, this sort of crisis of confidence more than anything else, especially with the regional banks, how long do you expect that to really keep reverberating? And could we perhaps see some M&A action in this space?
Well, I think you've identified an important point. That's something that we're going to have to really keep a very close eye on in the next couple of weeks, because one of the risks and the biggest danger in a shortfall of confidence in the American banking system is that you'll see a sweep of deposits that will go from the small regional banks up to the big banks. And what that would mean is an undue concentration for bigger banks that continue to be ever too big to fail. And that means that a larger concentration of more services by fewer banks means higher costs ultimately for the consumer. And that's not good for the system. So there is a short-term danger of a transition away from regional banking. But I think that the FDIC and the Treasury have done an excellent job of instilling confidence. So although that is a short-term risk, I think that has been significantly moderated. Keep an eye on what happens over the next couple of days in terms of the interest rate environment and what Jay Powell has to say. But for now, especially in light of the new facility and the lending window that's been provided to Credit Suisse in Europe, and of course they have their own historic problems. For now, as long as we don't get flooded by black swans, it looks like we will hopefully have pretty clear sailing ahead.
Well, here's hoping so. Always great to get your insight. Seth Berenzweig there, managing partner at Berenzweig Leonard. Thank you so much for joining me this morning.